This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. UDAP, unfair, deceptive, or abusive acts or practices, UDAP. Let's start with UDAP, which stands for unfair, deceptive, or abusive acts or practices. The Dodd-Frank Act made these practices illegal. An act is considered unfair if it causes significant harm to consumers. The harm isn't something consumers can easily avoid, and the harm outweighs any benefits. Deceptive acts involve misrepresentations or omissions that could mislead a reasonable consumer and are important to their decision-making. Abusive acts interfere with a consumer's ability to understand the terms or take advantage of their inability to protect their own interests. Prohibiting kickbacks. Next up is RESPA, the Real Estate Settlement Procedures Act. This law is all about making sure real estate transactions are transparent and fair. It prohibits kickbacks and referral fees, which means no one can get paid just for steering business to a particular service provider. This helps protect consumers from being charged unnecessary or excessive fees. Gramm-Leach-Bliley Act, Pretexting. The Gramm-Leach-Bliley Act is another important piece of legislation. It protects consumers' non-public personal information and requires financial institutions to have privacy policies in place. One key aspect is preventing pretexting, which is when someone tries to get your private information by pretending to be someone they're not. This act makes sure your personal info stays secure. Fairness in lending, ensuring fair treatment. Fairness in lending is crucial, and there are several laws to ensure it. The Equal Credit Opportunity Act, ECOA, Reg B, prevents discrimination based on things like sex, race, color, national origin, religion, marital status, age, or whether you're on public assistance. The Fair Housing Act of 1968 also prohibits discrimination in housing transactions, protecting classes like race, sex, color, religion, disability, national origin, and familial status. Practices like blockbusting, steering, redlining, and refusing to sell or lease are all illegal. The Community Reinvestment Act, CRA, encourages banks to meet the credit needs of their communities, including low and moderate income neighborhoods. Fraud detection, recognizing and reporting fraud. Fraud is a big issue in the mortgage world. There are two main types: fraud for property, where a borrower lies to get a mortgage, and fraud for profit, where lenders or third parties engage in schemes to make money. Recognizing and reporting fraud is key to keeping the system fair and secure. Mortgage fraud categories and red flags. There are many categories of mortgage fraud to watch out for. Asset fraud involves lying about your assets, while sales contract red flags might include the seller's name not matching the title report. Occupancy fraud is when a borrower lies about whether they'll live in the property. Income fraud involves falsifying income documents, and wire fraud uses telecommunications or the internet to commit fraud. Application fraud, employment fraud, and liability fraud all involve lying on various parts of the mortgage application. Constructive fraud is unintentional, often due to mistakes, while actual fraud is intentional deception. A power of attorney, POA, can be a tool for fraud if not handled correctly. The underwriter must approve any POA before it's accepted. Fake POAs are a major cause of fraud in mortgage transactions, so it's crucial to verify their authenticity. Truth in advertising is essential in mortgage lending. All advertising and marketing materials must be clear and not misleading. If there's any suspicious activity, like insider abuse or potential money laundering, a suspicious activity report, SAR, must be filed. This is especially important for transactions over $5,000 or real estate deals over $25,000. Keeping an eye out for these red flags helps maintain the integrity of the lending process. Alright, let's talk about predatory lending and steering. Predatory lending is when a lender takes advantage of vulnerable borrowers by offering loans with really bad terms. This could mean high fees, sky-high interest rates, or loans that eat away at the borrower's home equity. Steering is another shady practice where lenders or brokers push borrowers into loans they don't qualify for or loans that have worse terms than what they could actually get elsewhere. Both of these practices are harmful and can trap borrowers in a cycle of debt. Predatory lending practices. There are a few specific tactics that fall under predatory lending. One is credit insurance packing, where the lender sneaks in credit insurance or other unnecessary products at closing, which just jacks up the borrower's costs. Another tactic is failing to report credit information. By not reporting how well the borrower is doing, the lender keeps them in the dark and prevents them from shopping around for better deals. It's all about keeping the borrower stuck with the lender. Price gouging is when vendors charge way too much for necessary services, knowing the consumer doesn't have any other options. Excessive fees are another big issue. This can include padding closing costs or inflating fees for things like appraisals and title charges. There's also something called unbundling, where they charge for services that are already included in other fees, essentially making you pay twice for the same thing. It's all about squeezing more money out of the borrower. High interest rates are a classic predatory tactic. Instead of setting rates based on the borrower's risk, lenders jack up the rates just to make more profit. Equity stripping is another nasty practice. Here, the lender pushes the borrower into a loan that drains the home's equity. This often leads to foreclosure, where the lender ends up taking possession of the home's value. It's a way for lenders to profit at the borrower's expense. Churning is when a lender repeatedly refinances a borrower's loan just to generate more fees and commissions. The borrower ends up paying a ton of fees without actually improving their financial situation. It's a way for lenders to make money off the borrower's back, often leaving them worse off than before. Steering is when a lender or broker guides a borrower into a subprime loan or a loan with worse terms, even though the borrower could qualify for something better. Targeting is similar but involves specifically going after vulnerable or less informed borrowers to offer them high-fee, high-risk loans. Both practices are about taking advantage of people who might not know any better. Double selling is a risky move where a mortgage originator submit. Telemarketing and consumer fraud prevention. Telemarketing Sales Rules, TSR. Let's start with the Telemarketing Sales Rules, TSR, which are enforced by the CFPB to protect consumers from fraud and abuse. These rules have some key provisions. First, there's the Do Not Call provision, which means telemarketers can't call people who are on the Do Not Call registry. Calls are only allowed between 8 a.m. and 9 p.m. local time. Telemarketers also have to keep records of calls for 2 years if the person is on the Do Not Call list. There are also restrictions on payment methods, no cash-to-cash money transfers or check creation. And when it comes to robocalls, they're only allowed if the consumer has given prior consent, and the call must provide an opt-out option within 2 seconds. The Do Not Call list is managed by the FTC, and it's designed to stop unwanted telemarketing calls. But there are some exemptions. For example, calls for charitable contributions don't need to check the Do Not Call list. Mortgage loan originators, MLOs, have some leeway too. They can call previous clients for 18 months after closing and can contact prospective clients within 3 months of an inquiry. If they get written permission, they can contact clients without any time limit. Breaking these rules can be costly, with penalties up to $43,792 per violation, that's per call. Fair lending laws are all about making sure borrowers are treated fairly and without bias. The Equal Credit Opportunity Act, ECOA, and the Fair Housing Act both prohibit discrimination. There are a couple of ways discrimination can happen. Disparate treatment can be overt, like charging different rates for similar credit scores based on race, or it can be comparative, like giving a Hispanic borrower a higher rate than a white borrower with the same credit score. Disparate impact and redlining. Disparate impact is when a policy that seems neutral ends up disproportionately affecting certain groups, like setting age-based credit limits. Redlining is another serious issue. It's when lenders deny loans to people in specific areas, often based on race or socioeconomic status. Reverse redlining is the opposite but just as bad. charging higher rates or fees in low-income or minority communities. There are a lot of red flags to watch out for in fraud prevention. Chunking is when loans are split to get around regulations. Kickbacks are illegal commissions for referrals. Equity stripping is when lenders take a borrower's equity through high-fee loans. Predatory lending involves unfair loan terms aimed at high-risk borrowers. Churning is excessive refinancing just to generate commissions. And blockbusting is when someone induces homeowners to sell cheaply, then resells the property at inflated prices. Fraud for profit is organized fraud aimed at financial gain, like kickbacks or false loan applications. Fraud for house is when someone commits fraud to get housing, like falsifying income or documents. Straw buyers are people who buy property on behalf of others to hide the true ownership. Steering is when lenders guide borrowers into specific loan products based on their race, income, or gender. Discrimination can be overt, like obvious discriminatory practices, or it can be more subtle, like disparate treatment, which is unintentional but still unfair. Disparate impact happens when policies disproportionately harm certain groups, even if there's no intent to discriminate. All these practices are harmful and illegal, and it's important to be aware of them to ensure fair treatment for all borrowers. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.